Metals investors, wake up. Silver and gold may be entering a massive move. Something unusual is developing beneath the surface of the precious metals market. Silver is facing powerful forces from supply, industrial demand, global liquidity, and changing investor behavior, while gold continues to signal that the monetary environment may be entering a more consequential phase. But the most important development may not be the price itself. It may be what is happening behind the paper markets, physical supply, and global demand. And if those forces converge at the same time, the next major move in precious metals could look very different from the last one. The critical question is, how early is this cycle, really? Welcome to Precious Metals Intelligence, where major developments in gold, silver, monetary policy, and the global economy are examined through a long-term strategic lens. For viewers who value measured analysis over market noise, the channel provides a focused look at the forces that can shape wealth and purchasing power over time. If this type of analysis is valuable, viewers are invited to subscribe and follow the channel. And before continuing, viewers are also encouraged to share where they are watching from. It is always valuable to see how widely these monetary developments are being followed. The precious metals market can sometimes send a confusing message. Gold and silver can fall sharply on a particular day, even while the larger forces supporting them remain firmly in place. For investors watching only the daily price, such a decline can look like a warning that the entire trend is ending, but that conclusion can be misleading. A long-term market does not move in a straight line, especially when the forces behind it are connected to debt, inflation, global politics, currency confidence, and limited natural resources. The recent pressure on gold and silver therefore deserves attention, but it should not automatically be interpreted as the end of the move. In fact, the more important question is whether the short-term weakness is simply another correction inside a much larger cycle. That distinction matters because investors who confuse temporary volatility with a structural change can make decisions based on the wrong time frame. The precious metals market has repeatedly demonstrated that major advances can contain painful declines, long periods of consolidation, and sudden reversals before the larger trend becomes visible. Several forces are now shaping that longer-term picture. Government debt remains a major concern across many large economies, while inflation continues to influence how investors think about the future value of currencies. At the same time, geopolitical uncertainty has increased the importance of assets that are not dependent on the promise of a particular government or financial institution. Gold has traditionally benefited from this type of environment because central banks and investors often treat it as a reserve asset when confidence in the monetary system becomes less certain. Silver has a different character because it combines monetary demand with major industrial demand. That combination makes silver particularly important when the global economy enters a period where both investment demand and industrial consumption can rise. Another issue is supply. New mines cannot simply appear when prices increase. Developing a major mining project can require years of exploration, financing, construction, permitting, and infrastructure development. Years of limited investment in new production can therefore create conditions where higher demand places increasing pressure on available supply. This is one reason the current environment deserves to be examined as a structural story rather than as another daily market event. The historical comparison is equally important. Previous commodities supercycles have shown that major moves can continue for years and can produce gains far larger than investors expected during the early stages. One widely followed commodities cycle began around 2001 and continued into the following decade. During that period, the broader commodities sector experienced a dramatic rise, while silver moved from only a few dollars per ounce to nearly $50 at its peak. The important lesson is not that history will repeat itself exactly. It is that commodities can experience long periods of underinvestment before supply becomes constrained and prices begin responding to stronger demand. Once such a cycle develops, the market can remain stronger for much longer than expected. Yet, even during that earlier period, prices did not rise smoothly. There were repeated declines and recoveries. On a long-term chart, those fluctuations can almost disappear and make the entire cycle appear like one continuous climb. In reality, investors had to endure many difficult periods along the way. That same principle is important today. A red day, or even a weak month, does not automatically invalidate a multi-year thesis. The current cycle may also have characteristics that make it different from the previous one. Debt levels are higher, geopolitical tensions are more complicated, and the global monetary system faces pressures that were not identical 2 decades ago. At the same time, gold and silver are attracting attention from different parts of the global economy. Central banks have continued to view gold as an important reserve asset, while industrial users require silver for technologies connected to modern economic growth. These forces do not guarantee higher prices, but together they create a market environment that deserves serious attention. The key distinction is between price volatility and structural direction. Price volatility can change within hours. Structural trends usually develop over years. Investors who focus entirely on the first can easily miss the second. The same market that appears weak today can still be operating inside a much larger upward cycle. For serious decision makers, the objective is not to predict every daily movement. It is to understand which forces are temporary and which forces have the potential to remain in place for years. That leads to the central issue surrounding gold and silver today, the possibility that the current commodities cycle is still much younger than it appears. If the previous major cycle produced several 100% gains across the broader commodities sector, then an early move in the current cycle should not automatically be treated as the final stage. The market may still have significant room to develop if supply remains constrained while monetary and industrial demand continue to expand. That does not mean every forecast for dramatically higher prices will become reality. It means the conditions deserve to be monitored with a longer view. For investors, the greatest risk may not be a temporary decline in silver or gold. The greater risk could be dismissing a structural shift because of short-term weakness. The next stage of the story will therefore move beyond the price chart itself. It will examine what is happening inside the silver market, where unusual options activity, physical demand, industrial consumption, and limited supply may be creating a much more complicated situation. If those forces begin moving in the same direction, the question will no longer be whether precious metals are participating in a cycle, but how powerful that cycle could ultimately become. Silver has a feature that makes its market very different from many other commodities. It sits between two worlds. It is both a monetary metal and an industrial material. That means demand can come from investors seeking protection against monetary uncertainty, while manufacturers need the same metal for products used across the modern economy. When those two sources of demand begin moving in the same direction, the pressure on the market can become much more significant than the headline price suggests. This is where the possibility of a silver squeeze becomes important. A squeeze does not simply mean that prices rise quickly. It means that available supply becomes increasingly difficult to obtain while buyers become more aggressive. And the market can then enter a situation where higher prices are required to attract enough metal into the marketplace. The warning for investors is that this process can develop quietly, long before the broader market recognizes what is happening. One area receiving attention is the options market. Options allow traders to position themselves for future price movements without immediately purchasing the underlying metal. When unusually large numbers of call options appear at prices far above the current market, they do not guarantee that silver will reach those levels. However, they can reveal that certain market participants are preparing for a much larger move. The important point is not any single contract. It is the combination of positioning with other market signals. If substantial call option activity appears while silver faces a structural supply deficit, industrial demand remains strong, and physical premiums begin increasing, the individual pieces start to form a larger picture. Professional investors understand that one indicator rarely tells the entire story. What matters is whether several independent forces begin pointing in the same direction. That is why unusual options activity deserves attention without being treated as proof of a predetermined outcome. The physical market adds another layer to the equation. Silver mining cannot respond immediately when demand increases. A mine requires years of development, and existing operations cannot simply double production overnight. Even when higher prices encourage new investment, the additional supply may arrive long after the demand increase has already occurred. This creates an important difference between financial markets and physical markets. Paper contracts can be created and traded almost instantly, while new ounces of silver require real geological resources, equipment, workers, financing, and time. If industrial demand continues growing while investment demand returns at the same time, the available supply can become increasingly important. Solar technology is one example of the industrial demand story. Silver is used because of its electrical properties, and modern energy systems continue to require significant quantities of conductive materials. Other technologies may also contribute to long-term demand. The result is a market where silver consumption is not dependent on investment sentiment alone. India provides another important part of the story. The country has a strong relationship with physical precious metals, and silver plays an important role in both investment and industrial activity. When restrictions were placed on silver imports, the immediate effect was not necessarily the disappearance of demand. Instead, reduced availability contributed to higher local premiums. A premium represents the additional amount buyers are willing to pay above the broader reference price to obtain physical metal. When that premium becomes large enough, importing silver can remain attractive even after accounting for licensing requirements, duties, and other costs. This creates an important economic signal. If buyers continue paying elevated premiums despite restrictions, it suggests that underlying demand has not disappeared. It has simply encountered a barrier. Once that barrier begins to weaken and imports resume, previously delayed demand can return to the market. That possibility becomes more significant when other major sources of demand are also beginning to strengthen. The Western investment market is therefore another piece that deserves close attention. Silver-backed exchange-traded funds have experienced periods of declining holdings, meaning a significant source of investment demand was not fully supporting the metal during certain periods. If that trend were to reverse while Indian physical demand improves and industrial consumption remains strong, the market could face a very different balance between supply and demand. This is where the short squeeze argument becomes more interesting. It is not based on one dramatic event. It depends on several pressures arriving together. Strong industrial demand could absorb more mine supply. Physical investors could begin accumulating metal. Exchange-traded funds could increase their holdings. Options traders could position for higher prices. Meanwhile, mining companies would still need years to bring meaningful new production online. Under those conditions, higher prices could become the market's way of rationing limited supply. The crucial question would then shift from whether silver can rise to whether the market can source enough physical metal without a much larger price adjustment. That distinction is important for serious investors. A short squeeze cannot be guaranteed, and high option activity does not prove that silver must reach any particular price. Markets can change direction, demand can weaken, and speculative positions can disappear. But the underlying structural conditions deserve attention because they can create an environment where relatively small changes in investment demand produce much larger price reactions. Silver is a comparatively small market when measured against the size of global financial markets. If even a modest amount of new capital enters the sector while physical supply remains constrained, the impact can be disproportionate. The market could therefore move from a slow accumulation phase into a much faster repricing phase. And that leads to an even larger question. If physical demand is strengthening while the traditional paper market remains heavily involved in determining price, what happens when the center of global precious metals activity begins shifting toward the regions that actually consume and hold the metal? That question takes the story beyond supply and demand and directly into the future of silver's global price discovery system. For decades, investors have largely accepted a familiar system for determining the price of gold and silver. Major financial centers in the West have played a powerful role in futures trading, contracts, and price discovery. But the global precious metals market is changing, and one of the most important developments may have little to do with the daily movement in the price of an ounce. The deeper change is taking place in where the metal is being demanded, stored, traded, and ultimately valued. As physical demand continues to expand in Asia, the financial infrastructure surrounding precious metals has increasingly followed that demand. Vaults, trading operations, financial institutions, and exchanges do not remain permanently tied to one region. Over time, they tend to move closer to the markets where the strongest business activity exists. That shift may appear gradual, but its long-term consequences could be substantial. If the center of physical demand continues moving east, the influence of traditional Western pricing systems could eventually face a much greater challenge than many investors currently recognize. This does not mean that established Western exchanges are suddenly disappearing or that their importance has already ended. Such a conclusion would go far beyond the evidence. The more important issue is whether the global market is becoming more balanced between different centers of financial and physical activity. China, India, Singapore, and other Asian markets have become increasingly important parts of the precious metal system. Over time, major financial institutions have expanded their presence in these regions, while vaulting and trading infrastructure has also developed. The economic logic is straightforward when demand for a commodity becomes concentrated in a particular region. Businesses connected to that commodity have a strong incentive to move closer to the customers, suppliers, and financial networks that support the trade. Once those networks become established, more participants follow. Traders arrive because there is liquidity. Financial institutions arrive because there are traders. Vaults are built because there is physical metal. Exchanges and standards develop because the market requires them. Eventually, the infrastructure itself can begin reinforcing the region's influence. The process does not happen overnight, but it can become powerful once it reaches a certain scale. This creates an important distinction between physical ownership and paper pricing. A futures contract can represent exposure to silver without requiring the immediate transfer of physical metal. That makes futures markets extremely useful for hedging, speculation, and price discovery. But physical markets operate according to different rules. Real metal has to be mined, refined, transported, stored, and delivered. If more of the world's actual silver is being consumed or accumulated in regions outside the traditional Western financial centers, then the relationship between paper trading and physical demand becomes increasingly important. A market can continue to publish a global reference price through established exchanges, while the underlying physical flows gradually become more concentrated elsewhere. Over time, that can create pressure for the pricing system to reflect the realities of the physical market more closely. The question is not whether paper markets will disappear. The question is whether their relative influence could decline as physical market power expands in other parts of the world. Trading activity provides another reason to watch this transition carefully. Large volumes of paper silver can change hands in a single trading session. At times, the volume represented by paper contracts can appear enormous compared with the amount of silver produced by mines over an entire year. That comparison alone does not prove that the paper market is disconnected from reality, nor does it prove manipulation. Futures markets exist precisely because contracts can be traded many times before any physical settlement occurs. However, the size of paper market activity compared with physical production does raise an important analytical question. How much of the price movement is being driven by financial positioning, and how much is being driven by actual physical demand? That question becomes more important when physical inventories become tight, or when buyers in major consuming regions are willing to pay significant premiums to obtain metal. The relationship between financial trading and physical availability, therefore, deserves continuous monitoring. Another subtle development can be found in the character of trading activity itself. If heavy volume has historically appeared during sharp price declines, but increasingly large activity begins appearing during strong upward moves, the interpretation can change. Rising volume during a price advance can indicate that more participants are willing to enter the market as prices increase. It does not guarantee that the advance will continue, but it can show that buying interest is becoming more active rather than simply reflecting temporary speculation. For investors studying a long-term cycle, this distinction matters. A market driven primarily by short-term speculation can reverse quickly. A market supported by growing participation, physical demand, and expanding investment interest can have greater durability. The challenge is determining which type of market is developing. That requires looking beyond one trading session and examining the behavior of investors, institutions, producers, and consumers over time. The broader implication is that the precious metals market may be entering a period where pricing power becomes increasingly global. The traditional Western financial system will remain important, but it may no longer operate in isolation. Physical demand from Asia, growing infrastructure in the East, and changes in global investment behavior can gradually create a more distributed market. This would represent a significant change because pricing power is not only about where contracts are traded, it is also about where the metal is available, where buyers are willing to pay, and where the deepest pools of physical demand exist. If that balance continues shifting, investors may eventually see a market in which physical premiums, regional exchanges, and non-Western demand have a greater influence on the global reference price. The transition could take years, but markets often change quietly before the consequences become obvious. And if the pricing system is already evolving beneath the surface, the next major catalyst may not come from another mining discovery or a sudden geopolitical event. It could come from something much simpler and far more powerful. Capital beginning to rotate into precious metals on a scale that the market has not yet experienced. The most difficult question in the precious metals market is no longer whether silver can move higher. The more important question is how far a sustained structural revaluation could go if several major forces begin working together. A $500 silver price is often presented as an extreme target, but it should be viewed as a scenario rather than a prediction. The purpose of examining such a number is not to suggest certainty. It is to understand what could happen if monetary expansion, supply limitations, industrial demand, and investment flows all become stronger at the same time. Markets can remain undervalued for years, and then suddenly change when capital begins recognizing conditions that were already developing beneath the surface. One way to examine the possibility is through historical relationships. Silver has often traded at a significant discount to gold, yet the relationship between the two metals has changed dramatically during different monetary and commodity cycles. If gold continues moving higher while silver begins closing part of that historical gap, silver could experience a much larger percentage increase than gold. Another factor is inflation. As the supply of money and credit expands over long periods, the nominal price of scarce physical assets can rise simply because the currency used to measure them has lost purchasing power. This does not mean inflation automatically creates a straight-line increase in silver. It means that the value of a limited physical resource can change significantly when measured against a currency whose supply continues expanding. Supply creates another important part of the equation. Silver production cannot quickly respond to a sudden increase in demand. Much of the world's silver is produced as a byproduct of mining for other metals, meaning higher silver prices alone do not always create an immediate increase in supply. Even when companies decide to develop new projects, the process can take many years. This creates an unusual market condition. Demand can change relatively quickly, but supply often moves slowly. If industrial users require more silver while investment demand is also increasing, the market may need substantially higher prices to balance those competing demands. In that environment, a large price increase would not necessarily be driven by speculation alone. It could become part of the economic mechanism that forces buyers and sellers to adjust. The investment side could become even more important through what economists call TAS capital rotation. For years, precious metals can remain a relatively small part of mainstream portfolios, while investors concentrate on stocks, bonds, real estate, technology, and other assets. But market leadership does not remain permanent. When valuations become stretched or economic conditions change, investors begin searching for sectors that have stronger long-term fundamentals or different risk characteristics. If gold and silver continue outperforming while the broader market becomes more uncertain, institutional investors may gradually increase their exposure. Large pension funds, asset managers, family offices, and individual investors do not need to move enormous percentages of their portfolios for the impact to become significant. A relatively small allocation shift into a comparatively small physical market can create substantial additional demand. This is where the $500 scenario becomes strategically interesting. If silver were to experience stronger industrial demand, tighter physical supply, renewed exchange-traded fund inflows, greater institutional participation, and a broader commodities revaluation at the same time, the resulting move could be far larger than a normal cyclical advance. Historical comparisons can provide useful reference points, but they cannot place a precise ceiling on a future market. A monetary shock, supply disruption, or widespread investment mania could push prices beyond levels that previously appeared unrealistic. At the same time, there are obvious risks. Demand can weaken, interest rates can remain restrictive, investors can reduce exposure, and new supply can eventually enter the market. A disciplined analysis therefore has to recognize both the potential and the uncertainty. The most important issue is not whether silver will reach exactly $500. It is whether the market is developing the conditions required for a major repricing. The previous sections have shown how physical demand, industrial use, paper market positioning, global pricing structures, and limited mine supply can interact. The final ingredient is capital. If the broader investment community begins to recognize that precious metals are not simply defensive assets, but strategic commodities with constrained supply, the amount of capital-seeking exposure could change dramatically. The transition can happen slowly at first, and then accelerate once performance attracts attention. A sector that once appeared too small or too specialized can suddenly become important to investors who previously ignored it. For serious investors, this creates a crucial distinction. The opportunity may not come from correctly predicting the price on a particular day. It may come from understanding the structural forces before they become obvious to everyone else. Silver does not need to reach $500 for this thesis to matter. A significant repricing could occur at substantially lower levels if supply remains constrained and investment demand expands. But if monetary pressure, industrial consumption, physical shortages, changing global pricing power, and capital rotation converge at the same time, the upside scenario becomes much more difficult to dismiss. The real warning is therefore not that a specific price is guaranteed. It is that the market may be approaching a point where several independent forces begin reinforcing one another. And when that happens, the next move in silver and gold could be far larger than the previous one.